This segment sponsored by Foster Financial.
Welcome back to Wealth Wednesdays, where we are giving you sound financial advice. And of course, we have Caleb Doane, Vice President of Foster Financial. Hi.
Hi.
How's it going?
It's going well, thanks.
Good. Midweek.
Yes.
Really good information. I'm excited because today we're talking about the Feds and how they are raising the interest rates. What is going on? Share this.
Yeah, so of course at the end of March, the Fed raised interest rates another 25 basis points, which is 0.25%. And I think, we've talked about it a little bit before, but I think a lot of times people at home will think, hey, this is on the news all the time, but I don't really understand why it affects me. I'm not refinancing my house, I'm not taking out a new mortgage, so, what do the interest rates actually do to impact me?
Right.
And we talked a little bit before about how they can impact bonds in somebody's portfolio, but today I wanted to talk a little bit about how if somebody has a significant amount of cash in the bank, it can really impact them as well. And so, there's kind of a couple factors that are impacting that. First, we have to understand, why they're raising rates in the first place, and that's because inflation is so high. And then secondly, what could potentially be the solution to that is the fact that since they are raising interest rates so high, things like bonds and fixed annuities are yielding a lot higher rates. And so those are kind of the two pieces that'll be helpful for people to know.
Okay, and that really does have a direct impact on investors because this is where they're holding their money. And so as these rates inflate or change, rather, people are being directly impacted. So how are they?
Yeah, good question. So, the first piece with inflation. So, a lot of times we talk about how inflation is something that you're not going to see on your bank statement. You're not going to see it on your 401k statement. But over time, it slowly reduces the purchasing power of that cash that you have in the bank. So, if you just kind of think about it, $100,000 10 years ago could buy a nice, maybe 3-bed, 2-bath house on 10 acres of land, let's say. And now, if you still have that $100,000 and it was in your bank over the last 10 years, it's probably still right around $100,000 because interest rates were so low in banks. That $100,000 can now only buy, maybe a little bit more worn in, 2-bed, 2-bath on 2 acres of land, let's say. And so you can see how the purchasing power of that $100,000 has reduced pretty significantly over time. And that's really what the impact of inflation does.
Okay, and this inflation, so basically you're saying that it's a direct impact of inflation is based on why they are increasing the interest, and then that reduces the buying power of individuals. And so what can people do as this is happening? Like if their buying power is reduced, where does their power lie?
Yeah, exactly. So it's kind of a two-edged sword because, they're raising these rates to try to curb inflation, but since they are raising these rates, you can get a lot higher interest rate on something like a fixed annuity, for example. So typically, people's cash in the bank, it's not earning a very high interest rate. Usually the checking and the savings account give you very, very low yield, right? You're not looking at your statement every month to see how much interest you made because it's almost negligible.
Right.
And a lot of times people are hesitant to put their money in the stock market because it's so volatile, right? So, the solution is something that's, still a very conservative investment, but can yield a lot higher than what your checking or your savings account can. And so what we've been leveraging for a lot of clients is what's called a fixed annuity. And so it doesn't, fluctuate with the stock market. A fixed annuity has a stated interest rate. Right now, they're upwards of 5%. And so the stock market could go down 10%. The fixed annuity is still giving you 5%. And so the only thing you kind of trade off is a little bit of liquidity. In the bank, if you want the money, you can go get it right away. If you put some of that money in a fixed annuity, it's kind of set aside for a few years, but you get that stated interest rate and you get to retain some of that purchasing power that you'd otherwise be losing in the bank.
And so if someone doesn't know what an annuity is, can you describe that?
Yeah. So an annuity it's actually an insurance product, okay? So insurance companies will kind of issue these annuities, and what you do is, you give them the $100,000. They say, great, thank you. We will give you 5% interest on this $100,000 every single year for 5 years, let's say. After the 5th year, you get all that principal back plus the interest of that 5% for every single year. And then you can put it back in your bank or, put it in another annuity or something.
And so what is the main difference between an annuity and a CD? Because a CD also operates in the same way.
Yeah, that's a great question. So a CD, I would almost describe the CD as kind of playing right in between, like, being cash in the bank and being in an annuity. So the CD is maybe a little bit more liquid than the annuity, meaning you could kind of get to it within the term if you really needed to, depending on the type of CD. But the annuity typically pays a slightly higher interest rate.
Okay.
So that's the kind of trade-off. You give up a little liquidity, but you get a higher interest rate.
Okay, yeah, because you can't, once it's fixed and it's there, you cannot touch it.
Right.
Okay.
Or it's just a little more difficult. There can be, different surrender charges and stuff like that. And
Okay,
so
yes.
that's really the main thing that you give up. But it can be a great way to kind of retain some of that purchasing power, especially when inflation is at a 40-year high like it is now.
I cannot believe it. Well, thank you so much, Caleb,
Yeah.
for providing that information and really sharing with us ways to avoid losing our buying power.
Yeah, thank you for having me.
Yes, absolutely. And if you would like more information about Foster Financial, we'll be sure to list their contact information below so you can contact them and receive your complimentary consultation. We'll be right back.
This segment sponsored by Foster Financial.